Good morning, everyone, and welcome back to day 2 of our 9 days workshop on comprehensive HUF tax planning. Yesterday, we have covered the introduction to HUF. Today, we will focus on the legal framework governing HUF. These are the contents which we will be covering in our 9 days comprehensive HUF tax planning workshop. Over the next few days, we will dive into sources of income, what are the deductions and exemptions, what are the taxation rates and rules, and tax planning and management in relation to the HUF. And we'll also cover the partition of HUF and its tax implication, and review the real world case studies, and wrap up with the comprehensive conclusions. So let's get started. Before we dive into today's content on legal framework of HUF, let's take a moment to recap the summary points from yesterday's session on introduction to HUF. This will help us to reinforce our understanding as we move forward with the day 2 of the workshop. A Hindu undivided family or HUF can be formed in 7 distinct ways, which we have discussed in detail in yesterday's day 1 workshop. It's important to note that ownership of property is not a prerequisite for the existing of an HUF. It means that even if you are a beneficiary of the property, that would be fine to be part of the HUF. Additionally, individuals with separate properties cannot simply pool their assets to create an HUF. However, if properties are to be thrown into the common pool, a designated HUF entity, even if it holds no assets initially, is essential. A co-partner, which refers to a smaller family unit with joint ownership, is distinct from a full HUF. HUF can legally exist with just 2 members, one of whom must be a co-partner. However, for the tax purpose, a minimum of 2 co-partners is required unless the funds are received through the partition of the larger HUF. While it's not mandatory to have a legal deed to form a HUF, but it is highly advisable to maintain a written document outlining the key details such as property ownership and sources of income to ensure clarity and compliance. Coming over to today's topic, Chapter 2, Legal Framework for HUF under the Income Tax Act 1961. Recognition of HUF as a separate entity. Under the Income Tax Act, HUF is recognized as a distinct legal entity separate from its individual members for taxation purpose. This means that the income and assets of the HUF are assessed independently from its member. And what's the legal status of HUF? HUF is treated as a separate legal entity when it comes to income tax assessment. It is distinct from its members, allowing for an independent taxation. As far as the PAN card is concerned, which is permanent account number, HUF is required to maintain its own PAN separate from its members and is responsible for filing its own tax return as an independent entity. Determination of residential status. The residential status of HUF plays a critical role in determining its tax obligations. The status is based on where the control and management of the HUF are located. The criteria is that a residential HUF is one where the entire control and management of the HUF are situated within India. If the control and management are either partly or wholly located outside India, then it is a non-residential HUF. The residential status of the HUF significantly impacts its tax liabilities and the scope of income to be taxed. The residential status of the Karta determines the residential status of the HUF. As we conclude day 2 of our comprehensive HUF tax planning workshop, we want you to thank each of you for your participation and engagement. We hope today's session on the legal framework provided valuable insights into structuring and managing your HUF effectively. If you have any further questions or need personal guidance, feel free to reach out to us. You can contact us at our mobile number or visit our website or send an email displaying on your screen. We shall meet tomorrow on the day 3 of the workshop. Thank you.